in the last few minutes, I thank you for listening to us. We gave you some background about who we are, what we're doing, how the technology operate, and what's the benefit that are embedded in it. In this coming slides, we translated to a commercial path where we will establish pilot, and we'll move forward with a 5-year plan that we are eager to share with you and show you why it's really the right time to invest in the company at this point of time. What I'm showing you in this slide is a simple case study that we've been doing on polyethylene. This is just some lab results that you can see, but on the left, when we're processing pure single stream of plastic, in this case polyethylene, we came up with 90% liquid yield that's worth quite a lot, and we can sell it. So in other words, it starts maybe in a certain value, maybe $200 in one case per ton. In Europe, it's about $650 per ton, and in Mexico, for example, it's worth less. Okay, but 90% of it can come up and produce into transform into a product that's worth closer to $1,000 per ton with a liquid yield of 90%. Then we produce about 6% of gas and 4% of byproduct. Of the 6% of gas, I should say that 60% of them are just the gases that we can use to regenerate the system, which speaks a lot to the level of energy we require. The system is required on one hand, and so we need to compensate and add some energy, but it's really efficient. As you can see, it's very, very efficient process. On the other hand, 40% of those 6% are just CO2. Okay, so we have about 2.4% of the total mass that is coming out as a CO2, but really this is a very low number in comparison to anything out there currently. Keep in mind that we can do the same. We will not have the same result, but we will have higher result. We anticipate success, quite impressive success, where we will operate on the other type of polymers, such as polystyrene or polypropylene, or even mixture of those. The whole idea is to take this liquid yield and turn it into something that you can later do something with it. So in our case, we are thinking circularity, and so this oil that we're producing will move into a process to create new plastics, but it can also produce fuel, for example, and so we can answer to different needs in different territories, basically. Just to keep on why this is so attractive to the world, or to customers in terms of the circularity mode. So this is just a kind of a layout of what happened. What happened with the PE, polyethylene, in this example. And so there is a process there that takes ethylene and create plastic, PE plastic out of it, polyethylene, and then you move that into some kind of a product, and those products end up in the post-consumer, I'll say in the shops. You buy those things and then you drop them down and they end up in the waste, and we come down and collect them, or just process them. When we process them, we break the component back to an oil that could be used again to create polyethylene. So it's full circularity mode in our case. And bear in mind, we can do that again, as I mentioned, to other types of mixture of plastic, such as polypropylene or polystyrene. We're just now going to do some work on PVC, and so our goal is to increase our capabilities. But it gives you a sense, if we have a process out there that can operate in such level, in small scale, at low energy, and prevent a lot of the material to enter the waste stream, what does it mean? Well, it means that, for example, in terms of the customers, we can approach a customer that otherwise would dump this whole thing into the landfill or into some kind of plastic or conversion or a collector. For such customer, this will be a cost center. And as the case with one of our possible engagement, we are offering a customer with a complex feedstock, such as food packaging, a concept where we turn a cost center into a profit center, where the customer could return that type of material back to his supplier and gain credit for it, just to give you an idea. So, you know, if this is a sector related, say food packaging, we can multiply it across, you know, that solution across food packaging. If we're working in the same sector on agricultural, we can work there and multiply our operation in agricultural. That means basically that, you know, we are preventing for that type of waste to move into the land stream, and we keep it really without transportation at the same place, turning it from, I'll say, cost center to a profit center. As we move forward, we develop our concept of commercial concept. So what do we see basically? We talked about the technologies being able to be scalable in a small scale and being able to scale up. So basically, we envision small units with really good return. And in the next few years, we will develop a process that will be able to capture quite wide range of mixture of plastics, but it will start with a small unit, only 25 tons per day. And the idea is that if you have projects later that are bigger than that, you can just expand it. You can, you know, we call it train reactors, and we just add based on the project, just more trains into it. So, you know, what you see in this scenario are two cases, one of 20 tons per day with the performance that it has, but also a case of maybe 9 reactors, you know, 200 tons per day. And so the vision is basically to you know, after 3 or so years, just before that, between the 2 and the 3 years, to start fund the growth of the company and do work on projects rather than on the technology. So our plan is to commission 25 tons per day reactor and expand our processing capacity by adding additional reactor train. As I mentioned, this slide represents 8.5 tons per year of a commercial unit, and you can see what's the gain if we're doing it, you know, what's the gross margin. We also give you an example of 200 tons per day, but I like to say that this is not the limits. I mean, we will approach different opportunities that has anything from 20 tons to 300, 400 tons. And all you have to do is, you know, think of it, you start with a lower cost scenario, maybe with 1 or 2 train reactors. You like what you see, you understand the market, and you move on and you increase your capacity. So every customer that we have basically has the opportunity to grow, because the customer understands best how to capture the waste around it, but also through our marketing program to provide the demonstrations, we will engage new customers. And, you know, going forward through the years, you'll see that there is quite a lot of opportunity to extend our commercial project. At the high level, you can see that there is a gross margin that is improving by about 12% in the plant. And that is mainly a factor of the economics of the scale and the manpower that required to run the equipment. Just to give you an idea, I mean, this use case illustrates a very healthy gross margin, close to 50%, and a payback of around 6 years. It is important to know that in this calculation, we have been using 80% yield versus the 90%, for example, yield that we mentioned before. I mean, we're taking measures to you know, act conservatively, and going forward, you know, as the performance will present itself, we'll improve those numbers. Anticipation is that we will improve those numbers. So what you see here, basically, this slide represents really a comparison between a licensing and an own-operate model. Here you can see that the own-operate routes deliver slightly lower gross margin with a significantly higher total gross margin dollars. Basically, we have to, on the own-operate, we have to pay for the feedstock, and the licensing we don't. That's quite natural and understandable. But the dollar gain is a threefold, right? And what we gave you here is the same case scenarios and just an opportunity to see how we see things between the licensing and own operate. What I do like you to take from this, although we spend a lot of time to talk about licensing, I think our approach is to provide solution to customers. And so with that in mind, we will work with the customers. Some customers would want us to build on operate, and we will look into doing that. And some customers will just want to own some kind of a rights and move forward, and we will, of course, negotiate those as well. Slide 15, this is our path to commercialization. Since we've been going public in April, we've been delivered to everything we said on the, and plan basically at 2021, during 2021. The major item was for investor for us to demonstrate that the technology has some kind of a third-party validation. We did that, and we are going, marching forward towards building a pilot during 2022. We've been very busy over the last 6 months developing our relations with different possible collaborators and customers. Among them, I talked about Brightland and Switch Energy, and this list is growing as we speak. Our team has just come back from yesterday from travel in the Brightland, and I can tell you that the list of engagement is expanding. We have ongoing discussion with over 13 entities across 7 countries, some of which are global players. As we, again, for the investors that listen, the new investors, we always talk about our possibilities to provide solution to large-scale players and to small-scale players. And in this list, we have a nice mixture, blend of both. And it's been growing as discussed. The next step for us is to engage these customers in customers trial to also materialize upon those engagement. This is part of the significant milestones we want to achieve during 2022. Complete our pre-pilot unit, commission the semi-commercial unit in over the next 12 to 18 months, and move forward in a commercial scale. If once we have the pilot, and if you consider maybe Ontario as a hub that is doing demonstration, and in less than a year maybe brought maybe 10 to 15 possible engagement, our ideas fast forward in 2 years time is to multiply this hub and develop different hubs in each territory. And so again, we anticipate that in each territory we will have a similar size of commercial engagement from which we can materialize towards actual projects. So this slide takes a global 5 years outlook at our plan and strategy. As mentioned, in the short term, we will commence to build out our first pilot and initiate our customer trials program. In year 3, we plan to have our first commercial unit operation, followed by ramp up of a global expansion through the establishment of a territory hub. Those hubs, as I mentioned, we anticipate that in each geographic area we'll have some kind of a representation that will be handling projects. For each hub, at this point of time, we have a local team of about 5. We accounted local team of about 5 people operating out in the lab and engaging customers in their respective regions, with oversight and guidance by our Canadian team. This will allow us to expand our reach and to take advantage of the increasing demand globally. So we like to answer, as I mentioned, globally but locally to a customer, and we think this is the best right now, the best approach to do it. This slide represents our PROFORMA financial forecast. While the numbers are modest in the upcoming 2 fiscal years, we'll be executing some significant operational milestones, such as the pilot, with ramping up our customer trial program and commissioning our initial first pilot. In the short term, the company will mainly be generating revenue from paid customer trials, but again, those trials every year, we think we have a new flow of deals, potential deals from which we can convert them. Moving to year 3, We expect these numbers to become more significant with our trial commercial unit getting commissioned, at which point the company is expected to hit a break-even point. Things starts to get exciting as we expand our commercial unit and ramp up our processing. The level of growth seen in these 2 years can be expected to continue beyond year 5. In year 5, we plan to hit and even surpass a 95 million mark in recurring revenue with a very healthy EBITDA margin as outlined in this graph. Guys, this slide I like this slide very much because it represents, it's one of the first slides we put at the beginning of the, when we started the journey as a public company. We stated there our expectations that we have a processing unit worth anywhere between $10 to $50 million, and now we're backing it up with some information that is based on lab and engineering. And in terms of the market size, you know, we consider those numbers to be very modest. Really, the potential for the company is quite larger than that in every sector we are operating in. This slide is just to go back and give you some refresh on our share structure. Currently, we are, as you can see, a very tight share structure with about 48.9 million shares out there, inside ownership of 48%, some warrants and options in the making, and some special warrants that are out there for the insider, for the management. Basically, at the beginning of our journey, we put 66% of our ownership on the shelf, and we condition the receiving the return of those shares upon success. So the first time we perform the third-party validation, we brought about 33% of those shares back home, and we anticipate that in the next year will materialize based on the expected commercial engagement that we have, that we will materialize on those special warrants as well. The current market capitalization is also can be seen here. Thank you very much for having us, and we spend the time show you what is that technology, what's its capabilities, where we are, and I hope you get from this that we really think of the technology as a high growth investment opportunity, basically embedded in the technology benefits or the technology capabilities are a lot of benefits that cater to our market, that enable us to materialize on. So it's very modular and scalable. I spent some time to explain why the environment side is important and how we cater to emission reduction. It's very flexible in terms of feedstock, and it's diverse. Our capabilities can handle different types of feedstock in the single stream, multiple stream, mixture of streams. It's very cheap in comparison to anything others. Basically, it's operating in a low energy mode, as been discussed. And I can refer you to some presentation that we did recently in different conferences where our technical team speaks about why is it that we can operate in a low energy mode. Actually, quite fascinating presentations. If we're operating in a low energy mode and low capital cost, but we have very high yield. So of course, it's we have high efficiencies. I mean, we spend the time to explain and show you a case study of 90% yield. This is really unheard in this industry. And through our business model, we were even more conservative and considered 80% of this yield, just to be on the safe side. It has very little byproduct, and so we think those opportunities give the company a lot of potential to materialize on projects. So I hope in our presentation, with that, I'd just like to take you to the last slide and why really invest with us now? What's the opportunity right now? As I mentioned, this is a unique patent technology that has been independently validated. We're looking at an output really bigger than an 80% yield for our operation and the feedstock that we will operating with really a nice margin, nearing 50%. We have key engagements for our pilots, both in Ontario and in the Netherlands, and they are different. One of them is dealing with a single type of plastic. The other one is a mixture of plastics. We have an ongoing discussion that we gained in the last 9 months with potential customers across 7 countries, and we envision that if we'll build those hubs in the future, we will have the same deal flow in each territory, so multiple customers. We look at the ramp up of revenue occurring, annual revenue occurring, bigger than $90 million with a nice healthy margin of 80% by year 5. And also as a management, as I mentioned before, management is fully engaged and aligned with the shareholder goals to increase value with 50% ownership, and eager to and hungry to present itself and demonstrate its capabilities. I believe that we are, seriously undervalued compared with our peers. Most of our peers are, to this day, are north to the $1 billion in valuation. We are, we have a long way to go from our 35 current market cap. With that, I'd like to say thank you very much for your time again, and we will now open the discussion for a Q&A.
Thank you, Ofer. And now, I guess at this point, we're going to turn it over to our Q&A portion of the webinar. I sent a request out to anybody. If you haven't seen it already, please type in any questions that you'd like answered by Ofer and his team into the Q&A chat part. We've also received a few and been emailed a couple of Q&A questions. So, Ofer, I'll start with the first one. How is your EBITDA margin so high in year 5?
Dennis, thank you. Maybe Abe, maybe you want to answer.
Sure. As we've been modeling different opportunities and projections on what we will be able to build. So in year 5, we're forecasting 1 commercial unit, which will be owned by the company, owned and operated, and with remaining projects under license model. And so essentially, those would have 100% margin on them. So this, of course, can change with different opportunities that come along.
Okay. Thank you, Abe. Next question we have here is, with the recent dramatic rise in the price of oil and natural gas, is there an increased urgency from your perspective, customers to fast forward your development?
Thank you, Dennis. So the short answer is yes, but of course we wanted to think of this market on the long term, 20, 40 years ahead. And so only 2 years ago, we saw different scenario. We will absolutely increase our presence in terms of marketing and call out to customers to see us, and definitely accelerate our work, our current work in the lab to demonstrate the capability.
Excellent. Thanks, Ofer. I'm just going through the questions here. Ofer, here's another question we just sent in. How many projects are commissioned by the end of year 5?
Maybe Abe, you want to answer that?
Sure. Again, it goes back to the model, and by the end of year 5, we expect 12 projects up and running and under license, with one of them being a commercial project that we own and operate. That being said, our financial projections would increase significantly if we shifted some of these projects from licensed to own and operate projects.
Excellent, thank you. And I see another one here. When do we expect to have Aduro's renewable vertical in action?
28 months, in 18 months, less than 18 months.
One last question here I see here. debt financing for customers or for company build out. What does that look like?
Sure. You know, post piloting stage, we believe projects can be financed at a rate of 65 to 85% of capex through various different types of debt options. And this is assuming a 4 to 5 times multiple on the free recurring cash flow.
Excellent. Okay, well, I don't see any more questions. I just want one last round for anyone who has any questions. Going once. Twice. All right, listen, I want to thank everybody. I want to thank Ofer and his team here today for Aduro Clean Technologies and everyone who attended for listening today to the webinar. We will be posting the webinar on Investor Cube's YouTube channel shortly. So if you have any questions or want to review the presentation again, please feel free to see it. And I just want to thank everyone again for attending today. And we hope to see you again soon on our next webinar. All right, take care, guys, and have a great day.